The postcard version of Florida is still alive: the palm trees, the sunrise listings, the cash buyer from up north that every agent can recite by memory. But the real Florida story right now starts in a quieter place: a kitchen table, a storm-damaged roof estimate, and an insurance renewal that lands like a threat. In Cotalty's Florida on the Brink, the warning is blunt. Home prices in Florida are outpacing the national average. Miami is priced roughly 60% above Florida's average, and the insurance market is on shaky ground as reinsurance costs rise and premiums follow. So much so that many residents are skipping coverage altogether. This matters because Florida didn't just grow, it accelerated. Cotalty reports that between 2021 and 2023, nearly 2.76 million people moved into the state, helping make it the third most populous in the country. While migration pressure strained housing and public services, and yet Cotalty also points to early signs the tide may be turning, indications that Floridians are leaving. With almost half of outbound movers heading to Georgia, the Carolinas, Tennessee, and Texas, the risk is no longer theoretical. Axios Tampa Bay reports that about 1 in 5 homeowners in Florida are going without insurance, even as policyholders are pushed from the state-backed Citizens into the private market. Insurify projects Florida's average annual homeowners insurance cost could reach $15,460 by the end of 2025, numbers that can flip a dream home into a forced sale. So here's the question that should make every buyer, seller, agent, builder, and investor lean in. Is Florida about to repeat the cycle where boom turns into breakhand? The ones who move first survive it. Florida has always sold a certain promise: sunshine, growth, endless demand, and a housing market that could outrun almost any national slowdown. But the story is changing, and it is changing from the inside out, starting with costs that don't show up on the listing page. In Cotalty's Florida on the Brink, the warning is that Florida home prices have been outpacing the national average. Miami is priced about 60% above Florida's average, and the insurance market is under strain as reinsurance costs surge and premiums follow, pushing some residents to skip coverage altogether. That combination, high prices and fragile insurance, is not just a consumer problem. It's a transaction problem, a lending problem, and a liquidity problem. If a buyer can't lock down affordable coverage, closings get delayed, deals fall apart, and entire neighborhoods begin to trade at a discount that looks mysterious until you read the policy quote. Axios Tampa Bay reports that at least 1 in 5 Florida homeowners have decided to forego coverage altogether, a signal of stress that real estate professionals cannot ignore. Insurify projects Florida's average annual homeowners insurance cost could reach $15,460 in 2025, an expense large enough to turn a stable homeowner into a forced seller or a confident buyer into a renter overnight. At the same time, market conditions are no longer one-directional. HousingWire reports Florida's housing market cooled in late 2025, with homes taking a median 98 days to sell and a significant share of listings cutting prices, signs that leverage is shifting and that the next phase may reward preparedness over optimism. And Cotalty notes there are indications Floridians are leaving, with nearly half of outbound movers headed to Georgia, the Carolinas, Tennessee, and Texas, an early clue that the magnet state narrative is under pressure. If you want more reporting-style real estate analysis like this, where the hidden costs and policy shifts become actionable strategy, hit like, subscribe, and tell me what city and country you're watching from, because your support is what makes it possible to keep producing videos that help consumers and operators stay ahead of the next shock. Florida's housing stress is no longer mainly about what a home costs on closing day. It is about what it costs to keep that home financeable after the keys are handed over, and the variable tightening device is insurance. Cotalty's Florida on the Brink describes the mechanism plainly. Reinsurance costs are rising, homeowner premiums are rising, and many Floridians are skipping coverage altogether. When insurance becomes unstable, it stops being a household inconvenience and becomes a market-wide constraint on mobility, pricing, and liquidity. You can see the pressure in the payment stack. According to ICE Mortgage Monitor data cited by Axios Tampa Bay, homeowners insurance consumed 14.9% of the average mortgage payment in Tampa Bay as of December, one of the highest shares in the nation. That is what it looks like when insurance behaves like a second interest rate. Buyers qualify for less, bid less, and negotiate harder, while sellers anchor to yesterday's comparables and wonder why the phone stopped ringing. In a state where a huge share of transactions are payment-sensitive, first-time buyers, move-up buyers, retirees balancing fixed incomes, this shadow rate can cool demand even when list prices haven't fully adjusted. Insurify's projections put a concrete number on renewal risk. Insurify projects Florida's average annual homeowners insurance cost could reach $15,460 by the end of 2025, about a 9% increase from its 2024 estimate. At that level, one renewal can erase a year of rent growth for investors or break a middle-class budget for an owner-occupant. It also changes consumer psychology. People stop asking, "Can I buy this home?" and start asking, "Can I keep this home when the next bill hits?" That is a very different market. because it turns long-term ownership into a recurring underwriting event. The market is already showing the behavioral reaction. Axios Tampa Bay reports that at least 1 in 5 Florida homeowners have chosen to forego insurance entirely. Some can do that only because they own without a mortgage, but even then it matters to everyone else. Uninsured properties recover slower after storms, repairs get deferred, and distressed sales become more likely. That is how a private decision becomes a neighborhood vulnerability. As soon as deferred maintenance and storm damage become visible, buyers demand discounts, appraisers get conservative, and lenders get stricter. And socially, the pain concentrates where it always concentrates, among households least able to absorb shocks, seniors on fixed incomes, working families with thin savings, and communities where rebuilding capital is scarce. History explains why this cycle is so hard to break. The Insurance Information Institute's analysis of Hurricane Andrew notes the upheaval in Florida's property insurance market did not end with the 1992 storm. It reshaped underwriting and capacity for decades. Florida responded by building backstops. An FHCF overview published by AON notes the Florida Hurricane Catastrophe Fund was created in November 1993 after Andrew. The lesson for today's operators is that Florida has been here before. When losses and capital constraints collide, coverage tightens, costs jump, and housing outcomes follow. You cannot separate insurance capacity from real estate capacity in this state. They are the same pipeline. Those backstops are now tied to real estate outcomes through policy shoots that can change a homeowner's premium regime quickly. Axios Tampa Bay reports. Citizens reduced its policy count in the Tampa Bay area by nearly 90,000 year-over-year as part of depopulation, pushing policyholders toward private insurers. For consumers, the practical meaning is simple. The same property can become materially more expensive to carry even if nothing about the house changed. And when that cost change arrives without a pay raise attached, the homeowner's options narrow fast: cut coverage, take on debt, or sell. Non-renewals add another layer of friction. Central Florida Public Media reports Florida led the nation in the increase of home insurance non-renewal rates between 2018 and 2023, and cites a 2023 non-renewal rate of 2.99%. Each non-renewal is a forced shopping event, and forced shopping is where coverage gaps and premium spikes appear, especially for older roofs and older coastal stock. In real estate operations, that shows up as longer escrows, more renegotiations, and more contracts that fail late, after inspections, after appraisals, when the insurance quote finally lands. Now connect that friction to what is already happening in listings. HousingWire reports that in early November 2025, Florida homes took a median 98 days to sell. Nearly 44% of listings cut prices, and months of supply rose to 3.6, clear signs that buyers are regaining leverage. This is the market's message. Demand is becoming conditional, and the condition is total monthly cost and renewal uncertainty, not just headline price. In an insurance-stressed environment, market time becomes a referendum on carry costs. Here is the operational lesson you can apply immediately. If you represent buyers, treat the insurance quote like an inspection item, not a closing formality. Get it early, and make sure the buyer can survive renewal volatility, not just the first-year premium. If you represent sellers, price with the carry cost in mind, and expect sharper negotiations on older roofs, older systems, and any risk flags that complicate underwriting. If you lend or invest, underwrite renewal volatility the same way you underwrite vacancy. Assume it can jump, assume it can force behavior, and assume it can move the market faster than a headline price chart ever will. The second fault line in Florida isn't just single-family affordability. It's the dense, highly financialized housing stock that sits closest to the water, condos, and coastal communities where insurance, reserves, and financing rules can turn overnight into a market-wide liquidity event. Totality frames Florida as a state under pressure where prices and costs have surged over the last 25 years, and where the boom years between 2018 and 2022 were so intense that sales volume exceeded the 2005 peak. That single comparison should make experienced operators uneasy, because 2005 was not just a good year, it was a late-stage signal in a cycle that ended with forced deleveraging, collapsing liquidity, and a harsh repricing in the years that followed. Today the leverage is different, but the pattern rhymes. Instead of exotic mortgages being the primary fuse, it's the ownership cost stack and the assets insurability. According to Totality, Florida's median home price reached $393,500 in October 2024, surpassing the national average, while Miami's median listing price sat at $629,575, about 60% higher than the state figure. In the same section, Totality notes that in August 2024, the median single-family rent in Miami hit $2,944, underscoring that renters aren't escaping the pressure, they're absorbing it. And that's before you layer in insurance volatility. The risk becomes sharper when you look at how climate exposure translates into real monthly burdens and real underwriting constraints. Com esse 2025, Housing and Climate Risk Report finds that Miami has the highest homeowners insurance burden among the top 100 metros under an HO3 policy, with a premium to market value ratio of 3.7%. The same report warns that hurricane deductibles can run 2% to 5% of dwelling coverage, meaning a 5% hurricane deductible on a $400,000 dwelling coverage example can leave a homeowner paying $20,000 out of pocket before coverage even kicks in. For consumers, that is the difference between I am insured and I am financially resilient. For operators, it is the difference between a stable portfolio and a portfolio that turns fragile the moment a storm hits. Nowhere is that fragility more visible than in condos, because condos concentrate three stresses at once: insurance, governance, and deferred maintenance. Redfin reports that condo prices nationally fell year over year in May 2025, and that condos are taking longer to sell, with the analysis attributing part of the softness to soaring HOA fees, rising insurance costs, and large special assessments. Redfin also notes Florida as the epicenter of the condo slump, with prices and sales down over 30% in some areas. That is not a cosmetic change, it is a structural demand shock tied to total monthly costs, uncertainty, and financing friction. And financing friction is not an abstract concept. Fannie Mae's condo eligibility guidance emphasizes that projects with critical repairs deferred, maintenance, and special assessments can lead to unsafe conditions and financial hardships. And it notes that requirements addressing critical repairs and special assessments were incorporated into permanent policy effective September 18, 2023 for many condo and co projects. In plain English, a buyer can be fully qualified, love the unit, agree on price, and still get trapped because the building's condition, reserves, or assessments can choke mortgage eligibility. When that happens at scale, condo liquidity doesn't cool, it seizes. Florida's post-Surfside safety push is the historical turning point behind much of this pressure, and it's a moment the market has to respect. The Associated Press reports that Florida lawmakers approved changes to a condominium safety law passed after the 2021 Surfside collapse, acknowledging that owners, especially retirees and people on fixed incomes, have faced higher costs because the 2022 law required reserves for major repairs and periodic structural reserve surveys, and that the new bill aims to preserve safety while providing flexibility and relief. This is where the story becomes human. Safer buildings are a social good, and reserve funding is a long overdue correction. But the transition cost is real, and in a high-rate, high-insurance environment, that cost can push owners into distressed sales and push buyers away. The deadlines and compliance mechanics are also tightening the vice. Florida SDBPR Condo Resource page explains that certain associations must complete a structural integrity reserve study by December 31, 2025, and that for budgets adopted on or after January 1, 2025, associations may not waive required SERS reserves and must begin funding them in accordance with the reserve study. That is a direct pipeline into higher HOA dues and, in many cases, special assessments, meaning the monthly payment for a condo is becoming less predictable, precisely when buyers are most payment sensitive. Meanwhile, the single-family market is no longer absorbing endless demand the way it did during the migration surge. Cotality reports that between 2021 and 2023, nearly 2.76 million people moved into Florida, but it also notes indications that Floridians are leaving, with almost half of outbound movers headed to Georgia, the Carolinas, Tennessee, and Texas. And the market data shows buyers behaving like they have options again. HousingWire reports that in early November 2025, Florida homes took a median 98 days to sell. Nearly 44% of listings cut prices, and months of supply rose to 3.6, signals of buyer leverage and seller competition. Redfin similarly reports that active listings were near record highs statewide in early 2025, and that several Florida metros hit record high inventory, many of them coastal markets where homeowners often face higher disaster risk, insurance costs, and HOA fees. Here is the opportunity, and it's significant if you re-prepared. Florida can become the national laboratory for resilience-driven real estate mitigation retrofits: better roofs, stronger building governance, smarter underwriting, and clearer consumer disclosures that reduce ugly surprises. Even the insurance side shows glimmers of stable. HousingWire reports that Florida's homeowners insurance market has stabilized following 2022 to 2023 legislative reforms, and cites Alert Insurance research noting renewed insurer participation, including 18 new or relaunched insurers entering or planning to enter the market, while still warning that hurricane risk and regulatory uncertainty remain persistent threats. But the threat remains immediate. Florida is shifting from a pure growth story to a sorting mechanism. Assets that are resilient, well-capitalized, and easily financeable may hold value and attract capital. Assets that are fragile, high insurance exposure, weak reserves, deferred maintenance, financing restrictions may face a harsher repricing than many owners expect, and the market will not wait for consensus. It will move deal by deal, building by building, renewal by renewal. until the new reality becomes visible in the comps. Conclusões e lições dicas CTA final 350 palavras. Florida is not collapsing, but it is undeniably repricing risk in a way that consumers and operators can no longer treat as background noise. The state's housing market spent years behaving like demand was infinite and costs were negotiable. That era is ending. Totality as Florida on the Brink describes a state where home prices have outpaced the national average, where Miami sits roughly 60% above Florida's average price level, and where the insurance market is strained as reinsurance costs and premiums rise, pushing some residents to skip coverage entirely. When a market begins to ration insurance, it is also rationing liquidity, because financeable homes are the ones that can transact smoothly. The first lesson is for consumers: stop evaluating homes only by purchase price. Evaluate them by survivability. Before you buy, model the next 5 years of ownership with conservative assumptions about insurance renewals and deductibles. Realtor.com/climate risk report highlights that Miami has the highest homeowners insurance burden among top metros and warns that hurricane deductibles can run 2% to 5% of dwelling coverage, potentially leaving homeowners exposed to 5-figure out-of-pocket costs after a storm. If you cannot absorb that shock, you are not buying security, you are buying volatility. The second lesson is for agents, lenders, and closing teams. Treat insurance and condo eligibility as deal critical from day one. If you wait until the last mile, you invite late failures, renegotiations, and reputational damage. For condos, the rules are tightening. Florida's DBPR notes that certain associations must complete structural integrity reserve studies by December 31, 2025, and that for budgets adopted on or after January 1, 2025, required reserves generally cannot be waived and must be funded according to the reserve study. That is a direct driver of higher HOA dues and special assessments. At the same time, Fannie Mae's condo guidance emphasizes how critical repairs, deferred maintenance, and special assessments can create safety and financial hardship risks and can affect eligibility, meaning a building's governance can determine whether buyers can even get a loan. The third lesson is for investors. Florida is becoming a barbell market. Resilient assets will capitalized associations, documented mitigation. Stable insurance pathways may attract demand and capital. Fragile assets may face accelerated repricing, longer days on market, and forced selling. Redfin reports Florida is the epicenter of a condo slump tied to rising HOA and insurance costs and assessments, while HousingWire reports longer selling times and widespread price cuts across the state, evidence that buyers are already imposing a risk discount. So here's the question for you to answer in the comments. Is Florida about to become America's first climate-priced housing market, where the monthly payment is only the beginning, and resilience determines who builds wealth and who gets pushed out? If you want more documentary-style breakdowns like this built on real data, real policy, and real market consequences, hit like, subscribe, and tell me what city and country you're watching from, because your support is what keeps these videos coming.